So I launched my first hedge fund, and it was a macro hedge fund. It's what I wanted to do all along. I wanted to be able to get short, get long, use options and futures. And I built that out. And before I knew it, my assets were running over 100 million.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome everyone to Alt Investing Made Easy. Today we have an old friend with us, Larry Powell. Larry and Roland worked across the table from each other in the early 2000s when Roland was a general counsel at a fund of funds in Austin. And later they both worked together at Texas Teachers Retirement System, or TRS, where Larry ultimately served as the managing director of external public markets. Larry and Roland maintained contact over the years, and we reconnected with Larry because he truly can provide us with one of the most unique perspectives about how investment management professionals think about alternative assets. The key takeaway from this episode will be how professional money managers and asset allocators think, or should think, about alternative assets. And with all of Larry's experience in this area, his counsel is absolutely indispensable for emerging and seasoned investment managers, and we're just really grateful to have him here with us today.
Yeah, thank you so much for being with us here, Larry.
Absolutely. This is going to be fun. I'm looking forward to it.
Well, I'm personally really excited to have Larry as a guest. It's rare that you maintain relationships sometimes for such a long time period, and it was in 2004 when we first met and have stayed in touch intermittently throughout the years. And I can't emphasize enough how wonderful of a guest that Larry is for a podcast that talks about alternative assets. When I really worked together with Larry at TRS, he was overseeing Texas teachers' allocations to the external public markets. And it was a time in my career when I was still learning a lot, and Larry always was very humane with me and took great patience to explain to me some of these new concepts to me. And really what he was doing is teaching me more about investing in hedge funds and other managers that invested in public equities and other types of public securities. But also, frequently the ones that were using sort of esoteric trading strategies to try to generate alpha. But in any event, Larry now is working more as a counselor, trying to match investors with managers. And what he really focuses on most is making sure that there's a good fit between the needs and objectives of the investors and the managers that are seeking to meet those needs. We always think about returns versus risk, and then how you're achieving the returns. And Larry understands that different investors have different objectives and different tolerance for risks and different things that they're looking for in their managers. And Larry's just got such a depth of experience of getting to know managers and evaluating them that he's a great counselor to his clients to invest or to evaluate these managers. Real quick, I just want to give our typical disclaimer that this video podcast doesn't establish an attorney-client relationship and can't be relied on as legal or investment advice. To give you investment advice or legal advice, we have to enter into a separate agreement with you and specifically understand your circumstances. And Larry asked us that we specifically note that he's not licensed as an investment advisor, but rather consults with people to evaluate money managers who will probably be in turn subject to the investment advisor regime. This is an important regulatory consideration. So Let's move forward. And Sarah, I'll turn it over to you.
So, Larry, we had a chance to catch up last week, and it was such a wonderful conversation. I'm really looking forward to hearing more of a discussion today. But first of all, let's just start off with telling our audience a little bit about who you are.
Yeah, sure. You
We could start with it. I think you said something last time, didn't you, about the story of, what did you say? You had a term for it that was when you ask people to describe their background.
The long story, right?
Yeah, we called it the long story. And it's stuck at both, kind of a legacy of mine at both Texas teachers and then Utah retirement system.
Well, you're welcome to do the long story or your version of any of the long or the short story. I think we'd be happy to hear any of it, about your background, including where you grew up, all those things.
Well, I hope you have a lot of time, because my story.
We have all the time.
I've been in this business for 40 years, but it's interesting. What you're asking me is how we started out most meetings with managers when I was at both Texas teachers and Utah. And, we typically would, first of all, we would tell the managers to put their pitch books aside and before that, leave their sport coats and ties, in their hotel room, because we were just going to have a casual conversation. But anyhow, my long story is, you asked me when I was first got interested in, in the markets and where I grew up. I grew up in Chicago. I grew up in a suburb of Chicago, was a big ice hockey player and continue to play, up until 2020 when I had a little accident and had a concussion, and really missed the sport. But yeah. I probably played 4 or 5 times since then, but thought it was in the best interest of my health to maybe, as one of my bosses used to say, start playing shuffleboard instead of hockey or skiing. But anyhow, what really got me interested, and really I didn't have a whole lot of interest in it when I was younger. It's not like I grew up thinking I was going to be in the investments business. I had no idea. I thought maybe I'd be a fireman or something. But, my parents did an interesting thing when I was really young, and it was for all of us. We had a little contest. And they said, pick any stock, any company, and, we're going to see, here's point A where it's, worth this much. And then at the end, we'll evaluate it. And I don't know if there was any reward for it, but it was just like, I had 3 brothers and sisters, so a total of 4 of us. And I don't even remember what stock I picked. I have no idea. It might have been Disney or something like that. But that was kind of interesting. And I'm not going to say I won the contest. I can't remember if I did or not. But it was it was interesting and eye opening. We were pretty young, like I said, but it was really and I don't remember how old I was. Maybe 12 or 13 or something like that, maybe a little bit older. My dad used to go through his portfolio of stocks, and we used something called Value Line. I'm not even sure if it even exists anymore, but it was, it was hard copy. It was a big book, and, he would name the stock. I would go through it and say, oh, that's at $25 or something like that. And I was also surrounded. I mean, I was fortunate, and then I grew up in a nice area. My grandfather had a very successful electronics business, and he sold it to TRW. So we lived in a nice suburb, probably the nicest suburb on the North Shore of Chicago on Lake Michigan. So we were surrounded by people in the investments markets, the commodities markets, brokers, people involved in real estate. We sold my grandmother's house, who lived next to us until she passed away, to a neighbor of ours that, the kids are worth $100 million or more. I'm not that fortunate, but, they were in real estate and developers. So I was kind of surrounded by a lot of people that were in that business. But for me, it really wasn't until college that I got interested in the investments markets. And a good friend of mine, his dad was a market maker on the Chicago Board of Options Exchange. And he told me a story about this really successful trader. And he started in the 50s. He borrowed $2 million, which was a lot of money back then. And his father-in-law was the founder of a very successful publishing company. I don't want to name his name or, anything like that out of respect for the family. But he borrowed $2 million from his father-in-law, turned it into $30 million trading grains, wheat, corn, stuff like that. Those are the major futures contracts that were around. And he paid back his father-in-law and went on to amass a fortune. I mean, a lot of money. Nobody really knew how much it was. Maybe it was $1 billion. Maybe it was 500 million. I really have no idea. But when I heard that story, I knew what I wanted to do when I grew up, and that was my sophomore year in college, so I was really kind of lost. And once I figured out what I wanted to do, I was really able to excel in school. And because I knew what I wanted to do when I got out of college. And that's what I did, and when I moved back to Chicago, I was in Tucson. I went to the University of Arizona. And first thing I did was get a job, on the Chicago Board of Options Exchange. I actually spent a summer at a bank, and that was before I was on the exchange. And by the way I was dressed, with red corduroy slacks and, just not banking type of clothes. One of the people that I was in internship, and one of the people I was working with said, you might want to go over and work at the Board of Trade, So the following summer, I got a job as a runner at the Board of Trade in the grain room. That's where I cut my teeth. And then I finished school and went back and got a job on the Chicago Board of Options Exchange. And I started out as a runner, just, running tickets from the trading desk through the pits. This is back in the day when you had open outcry, and there was paper all over the place. It was kind of like Trading Places. If you remember that movie,
Sure.
Everybody does. How could you not? But anyhow, it literally looked like that. And the trading pits, people yelling, screaming, getting poked in the face with pencils and shoved, and that's what it was. And I kind of liked that. It was kind of cool. But the Chicago Board of Options Exchange was probably the most professional. Like, some people even wore sport coats, and ties that were actual ties, as opposed to like a leather tie that was like just kind of thrown on, which was more typical of the Mercantile Exchange and the Board of Trade. But anyhow, I ended up working for a trader who cleared a clearinghouse. They have every trader and anyone who invests in the market or trades has to be associated with a clearing firm. And the clearing firm was owned by the guy that I had heard about, the very successful trader and speculator. And so I got to know his kids really well. I started on the OEX, the S&P 100, which was the most active pit at the time on the CBOE. And I worked for this guy that made a lot of money every day, consistently. And it was, a really, I guess, it was a good experience. And eventually I was backed by a trader to trade in the S&P 500 futures. So I traded in the pit of the futures, but over at Chicago Mercantile Exchange. But pretty quickly I figured out this is not me. I'm not a short-term trader. I don't see this as a long-term career. And I left the trading floor, and I left the trading floor with the man that I talked about before, and I consider him my mentor. I've never really, it's kind of funny, right? A lot of people have a mentor that actually talk to them and sit them down and teach them what to, how they think and stuff like that. But I've really learned everything through osmosis. I mean, evaluating money managers and things like that, it was all trial by fire. And anyhow, moving on from there, when I was on the floor, everybody was looking at charts and technical analysis and stuff like that. And I left the trading floor in order to build a quantitative framework to trade like my mentor. That's what I wanted to do. That was my objective, was, to learn what he did. And, I learned a lot of things just by listening to his kids. And they would, talk about this and talk about that, talk about when his dad was buying stocks or futures and, and getting long the market and short the market, and, why he turned bearish in 1987 after being bullish from 1982 through 1987. Pretty much diehard bull, buying every time the market went down. And when the market crashed in 87, he was right. I mean, he was spot on. And, he took some heat on his position throughout the summer of 87. He was just selling the market. But, one day his son came into the office and he said, my dad's going crazy. He's selling S&Ps by the 100 lots, and that's a lot of money. That was like $200 million that he was short the market. I mean, for an individual, that's a lot of money. But anyhow, long story short is I spent 3 years from 1987 through 1989. I left the trading floor in May of 87 and set up an office with this guy's son. And I just read every book I could get my hands on fundamentals of the market. So I knew a lot about the technicals, but I didn't really know much about the fundamentals. And in the long run, the fundamentals run the market. Interest rates, earnings, stuff like that. That's key in understanding the direction of the market. So I built a number of econometric models and indicators and things like that. And my first client was me. I had like I said, I mean, I grew up in a nice area. I was fortunate. I had a corporate trust, small amount of money, nothing substantial, but it was enough to start building a track record. And I took over, my mom was the co-trustee, and she was able to, and me, convince the Continental Bank, which doesn't exist anymore, it's now Bank of America, to turn over the responsibility of managing that money. And, like I said, it wasn't a lot of money, but it was enough to start establishing a track record. The first year I started a tactical asset allocation firm. It's basically what I was doing, and allocating capital between stocks, bonds, and cash. And, using mutual funds. I don't think ETFs even existed when I started. So I was using index funds, but I've always been a big believer in index funds. And that's dating back to the 1990s. But anyhow, I had a conversation with someone. It's like 2 or 3 years into managing money. I wasn't really growing that much. I think I had about $5 million under management from friends and family, how everybody starts out. And I had a conversation with a guy who said, you have a great track record, but there's no bells and whistles. Nobody's getting excited. You're competing against Bankers Trust, JP Morgan, and other very large investment banks. And, it's going to be difficult for you to grow unless you do something more creative. So I launched my first hedge fund, and it was a macro hedge fund. It's what I wanted to do all along. I wanted to be able to get short, get long, use options and futures. And I built that out. And before I knew it, my assets were running over 100 million, and it was all about building a mousetrap. But I'm talking about all this because these were kind of the formidable, where I got my formidable skills, right? The foundation of my investment philosophy, my approach to managing money, but it also helped me understand, different types of strategies. A lot of people that go and work at a pension fund, they've never managed money in their life. They don't know what it's like to risk capital. They check boxes. They listen to the manager, and whatever they say, they believe, and it's not a good way to be evaluating money managers. But I would say, the most formidable thing that happened to me and life lesson in evaluating outside managers is the first manager that I allocated money to. I wasn't at Texas Teachers. I was on my own at that time. And I was, around, it was when I was around 5 million in assets under management. I met a guy at a conference. He was, a very well-dressed individual, with a really expensive suit on. And I was really impressed. He supposedly had $1 billion in assets under management. And it turned out he didn't. But the long story short is, I took a look at their performance and my performance. They traded in the FX markets, the foreign currency markets. And the thing about foreign currency markets is they're unregulated. And I found out there's a lot of things that, I learned about this group. There's two guys. I went into their office after, let me step back a little bit. I decided that, I wanted to allocate half my money to their strategy because it was just so uncorrelated and so different from what I was doing. It was very technical. It was shorter term, and it made a lot of sense. When they zigged, I zagged, and and they were supposedly big, right? They were supposedly $1 billion in assets under management. And I was so anxious to get something going that I decided I was going to allocate money to them. I thought they were going to allocate money to me, and then I started thinking about it. I was like, these guys have $1 billion under management. Why are they not giving me money? Why am I giving them money? But I did it anyhow. I opened up an account, and the fortunate thing is I had a separately managed account. I never gave them any money. I just gave them responsibility to manage, authority to manage part of my portfolio in a separately managed account. I called up the bank and that they were working with, and I called several references that they had, and they all had glowing things to say about these guys. They've been working for them for years, and blah 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 blah. And flashing forward a little bit, but talking about manager selection is all about a mosaic. It's is putting different pieces together and, and trying to figure out whether this person is, a fraud or if they're real. And, I've always said that you really don't know what's going on until you get inside, inside the shop. But anyhow, there was a number of things, just different red flags that occurred that didn't make sense to me. I didn't think about going in and, to see their office, but they invited me over to their office. And this is actually after we were in business together, and they were in a bank. They were inside a bank. They had an office inside a bank. And there's a reason that they did that. They did it because if someone came to visit them, they would be walking into a bank. And that person or that group, company that's doing due diligence on them, they felt would feel more comfortable because they're inside a bank. And that was all just a farce, right? But I went into their office and they had 2 desks. They were in an office that was 10 by 10 or, a very small office. Nothing on the desk, either desk, other than a computer screen. They were behind the screen. There was nothing there. I'm not even sure if it was their office, to be honest with you. But I didn't really think about that, but I thought it was kind of strange. I knew what my office looked like. There's papers everywhere, and it looked like somebody actually worked there, and I did. But their office did not look like they were working. And then at the time I was back, because I was living downtown. When I was on the floor, I was living downtown. And I moved back because my parents sold their house on the lake and they bought a house. But the house was a mess, meaning that it needed a lot of work. So I was living in the suburbs, but I would always go back like during the week, so I felt like I was working, and doing a normal job. I would drive downtown to Chicago and go back to my health club that I worked out at when I was a trader on the floor. And I ran into this guy, and I hadn't been there in a while. I had the membership, but I just hadn't been there in a while. And I ran into this guy, and he asked me, "Hey, what have you been up to?" And I knew that he was in the commodities business. And I said, well, I formed a joint venture. I've been trading. I formed a joint venture with this group. And he's like, "Oh, who?" And, and I said that they traded in the FX markets. And he said, "Who?" And I gave him his name. Those guys eventually went to jail, so I won't mention their name. But anyhow, he's all like, "Oh, last time I saw his first name, last time I saw Al, he had, he was working for us, and he said that he had gotten into he was moving into the FX business because it was unregulated." And you have to understand the industry to know the guy that I was talking to worked for a boiler room operation. It was not a well-respected place. And that's where this guy had started, that I had allocated money to, him and his partner. And now this guy tells me that he's moving into an area that's unregulated. I immediately picked up the phone, and this is the beauty of having a separately managed account. I immediately picked up the phone. I called the bank in London. They're there 24 hours a day because the market trades 24 hours. And I said, "Close out all the positions. I want to shut down my account and send the money back to me, or I'll pay whatever I need to pay." It turned out I actually made money. So they were doing some type of trading, but, I called the guys up and I said, "I'm done. I just don't feel comfortable about this, blah, 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 blah." And 12 years later, I was at a dinner, and I ran into. I was sitting next to a woman that a friend of mine had introduced or had invited to the dinner. It was a bunch of managers, a bunch of investors. It was in Florida, and she mentioned that she was working for an FX manager, and I'm almost done with my story. But anyhow, she mentioned she was working for an FX manager. She was raising money, and this is in 2009 or I think it was 2009 or 10. It might have been 2009. And I hadn't heard this guy's name in, it was 15 years or something like that. It had been a long time. And anyhow, she was talking in my ear and, talking a lot. And, I was just not really that interested. She was a realtor and she lost, her business because real estate went to, in the toilet in 2008 in Florida. And I was in Palm Beach, right, at this conference. And anyhow, I heard her say somebody's name. She mentioned the name of the firm, but I didn't remember that they had changed their name. And, anyhow, I said, hold on a second. Who are you talking about? Because she said she was going to have him fly in to meet me. And I'm like, what's the name of the guy that said his name, and his name was Dan. And I was like, okay, stop right here. I'm going to give you the best advice you've ever had in your life. I said, do not work with this guy anymore. I have 3 questions for you. Has he ever lost money in a year? She said, no. How long has he been managing money? 15 years. Okay. How much did he have under management? $1 billion. 15 years later, if he really was managing money and he had never lost money in a given year, he would have a lot more than $1 billion. And I said to her, well, that's exactly what he told me. And I said, who were his references? And she mentioned 2 banks. I said, those are the 2 references that he gave me. I said, listen, there is a 99% probability that this guy is a fraud. And what you need to do is get all of your clients, if you can, get all of your clients' money back, get all of your money back, and hope that you don't create a run on the bank, because you're probably going to create a run on the bank because these guys don't have any money. And sure enough, that's what happened. The run on the bank, these guys went missing for a while, and finally the FBI caught up to them and put them in jail. But anyhow, that was one formidable,
I remember, Larry, when we talked before, you had said that, and it's really great to hear that kind of a background story, and because, you've then taken that to go on and specialize, it sounds like, in helping avoid that situation as much as possible for the people that you consult with and that you advise. And I think, would you like to tell us a little bit about how that then informed what work you were doing at the 2 pension funds that you worked for, the 2 public pension companies, which was Teacher Retirement System and also in Utah Retirement System, right?
Yeah.
Because I think we talked about, and we'll get maybe into it, right? Roland, you'll get into it a little bit. We talked about how this formative experience really helped you start to establish a framework for how to evaluate these situations. So it's not just anecdotal to you and one experience you happen to have because you have so much experience, right? But how you've then taken that to use to basically spread the benefit of your knowledge to a lot of people, actually.
Yeah. It was things like that. It was situations like that helped me when I did join Texas Teachers. and knowing kind of how to put together that mosaic and teaching various members of my team. But maybe I'll kind of fast forward and talk about Texas teachers and where we were back then and where they are today, which is a very, very different organization. Just I joined in 2002, and we had a 1% allocation to hedge funds, and I don't even think we had it fully invested. I think we had about 90 billion in assets under management. It was a lot of money.
Yeah.
But there was a total of 2.5% invested in alternative assets. So we had private equity, and which had a 1.5% target allocation, and we had 1% in hedge funds. And the hedge funds that we had, some of them were good, some of them weren't really hedge funds. They were just things that got shoved in the portfolio because they had nowhere else to sit. Because almost 98% of the money at that time was managed by an internal team. And we were these crazy guys doing something that was totally different than what everybody else was doing at the firm. We're shoved in a corner office. I had a little tiny office, almost as big as the manager I was talking about. It may not have been, it might have been 6 feet by 6 feet. And, we had, that was my office. My responsibility at first was, and my focus throughout most of the time was hedge funds and building out a proper hedge fund portfolio. And then the rest of the people, a total of 6. There's 7. There was 6, and then we had an analyst, a junior analyst that kind of was roving and helping all of us. She was great. It was awesome. And then without her, we'd be lost. A bunch of guys and one girl. Which
sounds
has
about
changed,
right.
which has changed quite a bit, since then. But anyhow, I always said that we had a great filing system, but that's about it. And it was a really good filing system, but we didn't have a CRM. We had no way to, we had Outlook, and the guy that I was working with, came from the real estate side. The whole group was called Alternative Assets, and it was made up of the former head of Alternative Assets, and that's a whole long story. I won't get into it, but it's interesting how we were able to get involved in alternatives because we weren't before the, I don't know when I think the private equity started like in the early 2000s, maybe the late 90s, but Texas Teachers was in real estate. But by the time I got to Texas Teachers, we had a 0% allocation to real estate, 0. Wow. And it had been that way since the financial crisis. I mean, since the savings and loan crisis. And we had $500 million invested in real estate. And that was kind of an eye opener for me, given that at the max, I had a little over 100 million under management when I was running my own money. And now we have a 0% allocation, but we have $500 million invested. It was pretty mind boggling to me. But, anyhow, it was me and another guy that was previously running the hedge fund portfolio. And I kind of took it over because I was the only one who had experience in investing in hedge funds and managing money. allocating capital to, outside, internally, but to outside managers. It came, internal when I was running my hedge fund. But it was a real eye opener to me. They didn't have any technology, none. And, not even a system for like putting numbers and, returns and things like that and cranking out tear sheets. You just really had nothing. And a lot of what we did was they were doing when they first allocated money to hedge funds was RFPs. I had never done an RFP before. I had no interest in doing an RFP, and I never did an RFP because I didn't want to, but, today Texas Teachers has almost 200 billion in assets. They probably, I don't even know how many employees they have. I mean, hundreds of employees.
Yeah.
And, I think the alternatives allocation is like 30 or 40%. I don't know how much it is, but, it's a lot. And, so we didn't have a whole lot to work with. But, and we kind of, we stayed that way, small. The hedge fund team really didn't grow that much until 2007, when, Britt Harris came on as CIO. The assets that we had responsibility for, hang on a second. Sorry about that. It's supposed to be off. Anyhow, we had 7 billion by that time. We had 115 billion in the plan and 7 billion across the private equity. We brought back real estate and, and then hedge funds. But hedge funds are still at 1%. And, in 2007, we came up with a new asset allocation. We were talking about this separately earlier. We went from having 2% in emerging markets to 10%. And as I said before, now it's back down to 1%. So they've done a full round trip on that. And, hedge funds went from 1% to a projected 10%. I'll tell you a little bit about that. But they didn't go to 10%. And then private markets went from 3% at that time to a 10% target. Sure. Well, this was all great. It was a great idea. But when we announced it at the board meeting, well, the legislature was in session, which they are every 2 years. And we were in the process of pushing a bill through the legislature. The reason that we didn't have that much money invested in alternatives is, and the reason, more so, the reason why we were managing most of the money internally is because we weren't allowed to allocate money to outside managers. And the quick story on how we were able to do that in alternatives is there was a big problem in the state portfolio after the savings loan crisis. And someone in legal who Roland worked with came up with a really good idea, which was, hey, let's stop selling this real estate at fire sale prices and let's roll it up into a limited partnership. So, and then, hire a GP to oversee that. That's why we had 500 million left, in that portfolio by the time I joined, but it was also how we were able to get into hedge funds and private equity is we invested in limited partnerships and offshore corporations. But anyhow, when we made this big announcement that we were putting all this money into alternatives, that bill had gone through the House and was passed by the House. And the Senate was about to vote on the bill. And they heard about these big changes in the asset allocation. But what didn't bother them, which was shocking to me, was the 2% to 10% move in emerging markets. That didn't faze them, which is probably the most riskiest part of the portfolio, particularly of the portfolio, period. It's equities. And, but God forbid if you're going to put 10% into hedge funds. And so we had to negotiate with, the Senate, whoever it was. And I don't remember. Senator Duncan sounds familiar to me, but I'm not sure if my memory is that good anymore. But, we had, basically what we said is that we'll reduce the allocation in hedge funds. They're so dangerous. They're so risky, to 5%. And then to be reevaluated, 10 years down the road or something like that. But what they did, they put 10% into real assets. And I think they increased it to 15 or something. I don't know what they did with that 5. They put it somewhere else. So we still had a really big, it's huge. And everybody was sitting around. Then this was in 2007. Remember the peak of the stock market. And everybody was thinking about, well, the stock market's gone up this much. We're going to have this much money, down the road, because they were extrapolating that, historical return. We're going to have to put so much money into private equity, because when you put money into private equity, it's committed capital, right? And you have a target. The target was 10%. We were at 3%. The target in real assets was 10%, and we were at 3%. And, it's just psychology, right? You think, oh, well, whatever's happened in the past is going to happen in the future. So they were, targeting all this money that was going to be going, and then the stock market crashed, right? And I left, but I had built out a team, right? I built out a great team, external markets. We split up private markets with public markets. So that's how I became the head of, public markets. And I had to build out a team because I only had 2 guys. It was me and another guy. And, anyhow, I built out the team, and then I had, an attractive opportunity in 2008. I was there for, I don't know, a year or so, year and a half. I think I was at Texas Teachers after that, and ended up going to a Utah retirement system. And, I always said I inherited, I left a mess and I inherited a mess, because I joined in late August of 2008. But
that's what happens when you're good at what you do, Larry.
Yeah, I guess so.
Constant dealing with mess.
There was just, a lot of stuff that ended up in my portfolio that, that I wasn't really doing the due diligence on, but we were the only area that was allocating money to outside managers. So it was a big shift. I mean, it was a big shift. And, we had to build out this team. And, to be honest with you, I picked people like myself to join my team. There were a lot of people that, we went from, running most of the money internally to a target of running almost all the money externally. And that's why we were getting approval from the legislature, because we were going to now start allocating money to equities, which we had never done before, fixed income, which we had never done before, except internally. We'd never allocated money to outside managers. So, we had to come up with strategic plans and tactical plans and, a process. But we basically took the process that we had developed for hedge funds and, used it for public markets.
Right.
Yeah, I know this is a long story. I told you it was going to be a long story.
No,
I love it.
It's really good. I think
I've been around a long time, so
we should draw back a little bit and just contextualize it and think about how significant or large amounts of money we're talking about, because you mentioned it. We're talking about a time when Texas teachers at least went from less than 100 to over 200 billion today. And then, when you talk about 1% of 200 billion, that's $2 billion. I mean, it's a huge amount of money there. And we're talking about, 10 to, 30% of the overall portfolio. And you even mentioned that they, going up even higher in terms of who the, what percentage is managed by external managers. And that's the important point, I think, to really make in this, is that you don't have these internal employees that are making the trades. They do some of that, but what you're doing is writing checks to external asset managers, whether it's private equity, real estate, or hedge fund, and you're really relying on them to implement trading strategies, whatever it is. Hedge fund has there's lots of different strategies. Private equity, the same. Real estate, the same. Real estate's maybe a little simpler to understand than the others, but relying on these external managers to generate profits that in turn fund the pensions of Texas public school teachers. And it's such a critical function. And then understanding how significant the change was that occurred. And we're talking about some of the biggest names that we hear about BlackRock all the time. I remember, TRS was invested or is invested in BlackRock. This is all public knowledge, nothing's confidential, but I'm just trying to remember some of the other big names. BlackRock's private equity, KKR, Capstone, Blackstone,
Apex,
maybe I've got
that. Friedman, Friedman. Big, big groups.
You know what I think might be interesting, just to draw a correlation here for our audience, is that, this is such a large scale that you're talking about, and the number of people, this is their pension. This is what they're entitled to for the service that they've given to the state of Texas or in other states, right? This is very, very critical. However, for individuals that are, say, starting their wealth building journey and deciding on how to allocate money to an investment manager, or for people that are starting out with their own shop, kind of like you did, and using the resources that are out there now, which is a lot more connectivity with investment managers. You don't have to meet people at conferences necessarily. There's a lot of ways that people can connect now. That's still, for that individual or that smaller situation of a few million or 50 million under management, it's still very critical. It's usually your money or other people's money. This is financial security that you're essentially talking about, which is so critical for life. And so I think, it's just so great for the perspective that you're giving us, Larry, about how it's still people making decisions about what to do with these large amounts of money. Maybe you have the benefit of more diversification that can be done, but it's so critical that you're able to decide who to trust and how to go about evaluating who to trust in this process of growing money. Because let's be honest, pension funds have to grow, right? That's how it works. And that's how people can rely on having their pensions in the future. So I just think maybe it's a good time to get into that framework. You've set a great stage here. We haven't had a chance to talk about Utah yet, but you set such a great stage here for why you have the skills and the experience to set out the framework that you have for evaluating how to evaluate a money manager.
Yeah. As we've discussed before, I kind of view manager selection as more of an art than a science. And, having the knowledge, right? being, being able to understand what these managers are saying is critical.
Yeah.
Because they all talk in acronyms. And sometimes, when I was sitting across the table, I'm like, what is that? And I'm thinking in my head, okay, oh yeah, that's what it is. All right. Because, these acronyms are created in Wall Street, and I think they're created to confuse people. But, if a manager is coming across and he's talking, in a foreign language, and I don't mean literally a foreign language, but a language that you don't understand, and you're just not going to invest in that manager. But as I was building out my team, right, when I had the opportunity to actually build out a team, and by the way, we had probably 20 people on the alternative assets team before we split it up between private and public. The problem was the public side was really small, right? Because our allocation was so small compared, it was like at that time, 1% versus 6% in private markets. It was just me and one other guy, so in building out my team, as I started mentioning before, I specifically, got people that were managing money internally at TRS. So most of the people that I hired were already at TRS, and they were kind of free agents. Some didn't stay, some left, but a good portion of them stayed and were kind of spread out between public markets and private markets. But once again, I said I specifically hired people that had experience in those markets and understood the jargon. That's really key, is to be able to understand the jargon. If you don't understand the jargon, you don't have a shot at being able to evaluate a manager. And, even just, the initial stages of a meeting. So that for me, that was really important. And, the one guy that I had on my team, he had no experience of evaluating money managers, but he had chapter 1 of my career. He was a trader on the floor, and he traded options, and he worked on a trading desk in the bonds, and he understood the jargon. And he came to me, we have FT in the pension fund world, they have FTEs, right? And that was a big deal, full-time employees, right? And having enough FTEs in order to, build out a team. And we all had to sacrifice, the number of FTEs, the number of people, number of employees that we needed on each team. Private markets, public markets, strategic, at that time it was called strategic research and risk. And then investment accounting was brought in also, and IT was brought in. So, and we weren't going to be able to get 100 FTEs in order to, make this work. But anyhow, I split up the portfolio into equity, fixed income, and then what we call macro relative value, right? And the reason I did this is because, my feeling is that a lot of hedge fund managers can fit in any one of these segments. And if you understand the equity markets, you can understand a long only strategy as well as a long short strategy. So that team was agnostic, that equity team was agnostic to whether a manager was a long only traditional money manager like a mutual fund, but we didn't invest in mutual funds, but like that, right? Traditional, just buy stocks and sits on them forever. And versus a hedge fund manager who's going to be in and out and has a lot more tools in his toolbox. The ability to short, use futures, use options, and all kinds of different things that helps control risk. And so I built out my team in that way, and I hired 2 people that were on the equity team. Both of those people have moved on to much, more prestigious roles in Texas. And I hired a guy that worked in the fixed income portfolio that the team got completely disbanded. And, he's now the senior managing director of external public markets. And I hired him because he had experience. Not only did he have experience at Texas Teachers, building a portfolio of, bonds, corporate bonds and other stuff. But he worked previously at a insurance company that is almost all fixed income, most insurance companies. So that was really important to me, right? In hiring people that actually had experience trading. I did hire one guy who was supposed to be on the fixed income team. And, then the fixed income team got disbanded, but he was going to work there. And, I was a little partial. I mentioned it was a hockey player. I asked him where he's from, and he said Boston. And I said, "Oh, do you play hockey?" And he said, "Yeah." I said, "You're on my team." But he also had experience. He worked at Fidelity and some other areas where, he had experience in the markets. And then the macro relative value team was, other people. That was actually my right-hand guy, and then someone else. And then I hired a few people including someone who now runs all public markets for Texas Teachers, who was at, I believe, T. Rowe Price before, is Dale West, Texas Teachers.
Sure.
But anyhow, he was portfolio manager. He was an actual portfolio manager. Some people say they're portfolio managers, but they're not. They're really a liaison to the portfolio manager. He was actually managing money. So everybody had managed risk before. And it is really important that, that you have that skill set and you understand the lingo, as I said before. But, in terms of, in terms of actually doing due diligence, like I said, it starts out with the long story, and you get to know somebody. And the importance of the long story is that if you've been in the business long enough, you know a lot of people. As an allocator, you know a lot of people. You know a lot of organizations. You know where they've worked. If you have a good memory and you can remember, and when someone starts talking, it's golden, right? Because they love talking about themselves. And our long story was go back as far as you want. We had a guy go back to 2, and tell us, what did you do when you were a kid? What sports were you involved in? What kind of activities were you involved in? Were you working on computers and all that stuff? I mean, it was back in 2000, right? Computers just came out in like personal computers came out in 1984 or something like that. Now I think Apple may have had something before, but I know IBM, my dad worked for IBM. But anyhow, and walk us through your history, where you went to school, what was your major? Did you change your major? Why did you change your major? Where did you work? What was your first job? Who were your mentors? And what did you like about it? What did you not like about it? And, go through your entire career and how did you get to where you are, today? And if I didn't hear that, if I didn't understand how someone got from point A to point B, the whole meeting, I would be thinking about, well, why'd they do this? Why'd they do that? Because a lot of managers come in, they come in and they start talking about their portfolio. And we were always like, stop. We got to hear your background first. And that was really important to me. Because otherwise it was just a waste of a meeting. So that's the first stop, right? And once again, understanding the jargon, and then but when they give you that long story, you get a lot of references from that story because they're telling you who their mentors were, why they liked them, or why the mentor liked them, and why they were open to talking to them, and how they managed them, how they treated them, and things like that. But it gives you references, not that are given by the manager, but that you can reach out to, because the references a lot of times that managers give to you, they're a setup. It's like they know this guy really well. Of course, he's going to say wonderful things about him, but you also have contacts in the brokerage firms, in the administrative firms, and you can really understand a lot about that person and how they treat these different organizations, how they trade, how quickly, because a lot of deals that they're doing are sourced from Wall Street and from the investment banks. I remember when I was in Utah, in Park City, there were a lot of investment banking. Sorry about that. There were a lot of investment banking people that lived there, and either they had retired or they were living in Park City and flying to New York. And I remember meeting one guy, and we had money with a manager. And I had a friend of mine that worked for NatWest, it's an investment bank on the East Coast. And somehow this manager that blew up, in 2007, the name came up, and he told me about, this guy was a client of theirs. And it's like, he would take any deal. Anything that he brought him, he would take. If I had known that information, I would never have invested in that manager, because he shows you that he's not very discerning on the types of deals that he was doing. But so that's really important. And then we had a whole process for going through meeting a manager in their home office. Really important before you give them money. So I learned that lesson, the hard way. But, there's just so much, because, when a manager comes into your office, right, and everybody's coming to Austin because there's so much money here. But a manager comes into your office, they got their game on, right? They got their game face on, they got their marketing hat on, and, they're going through their presentation. And one thing that we did is that we said, put your presentation aside. We're just going to have a conversation. And that's what we would do. Otherwise they're just going through their pitch book, and actually going into their office, kicking their tires, meeting with people, not just the top guys, but meeting with the analysts, and get a better understanding, and look at the body language and things like that. If you can get them alone and talk, they're going to say a lot more about the organization than they are if their boss is sitting there in the room. So there's so many tricks and things that you learn. The other thing is, once again, a manager comes into your office, they want to ask you questions, right? And they want to understand more about Texas teachers and what we look for, or Utah, or wherever you are, about what we look for in managers and stuff like that. And if you say too much, they're gonna tell you what you want to hear.
For sure.
Right. And so you don't want to show them your cards or start. So I would always turn that around. I was like, no, I want to hear about you, and that's how the meeting starts. And then you talk about, risk and, portfolio construction and things like that. You have multiple meetings. I mean, pension funds and other institutional asset owners, they spend months and months, if not years, evaluating managers and, trying to figure out whether they're a good fit for the portfolio or whatever. It's a big process. And as you know, Roland, the legal process is lengthy.
Right.
I mean, once we had approval to, to allocate money we had an approved list on the hedge fund side, and,
right.
It moved to an IC. We had the internal committee where we didn't need to get approval from the board. A lot of things evolved, while I was at Texas Teachers, not just the amount of money that was being managed by external managers, but the entire process. And since then, it's evolved.
Hi, everyone. We're going to create a little break here in the middle of our interview with Larry to wrap up part 1 of this multi-part episode. In part 2, we're going to be going through Larry's rules to live by when evaluating investment managers. We're really grateful to hear Larry's personal long story because it's so illustrative of the point that he makes about evaluating investment managers and how much you can learn from somebody just by talking about their personal history. Thanks for watching this episode. If you enjoyed our podcast, please hit the like button and subscribe to our channel. Additionally, we want to remind everyone that Sarah and I are practicing attorneys at the law firm of Grable Martin PLLC, and we offer all our listeners a free consultation to talk further about any of the topics that we discuss on Alt Investing Made Easy. You can find our contact information in the show notes along with Larry's. Okay, well, please tune in next time to part 2 of our interview with Larry Powell of LP Institutional. And remember, everyone, take aim with your alternative investing strategies.